Hello traders and welcome to the first lecture in section 3 where we study our third and final technical analysis indicator in this strategy in the form of volumes. I have stated many times in part 1 of the course that volumes have been around for more than 100 years. Before the introduction of electronic charts, traders used a ticker tape to read volumes. In fact, volumes from a ticker tape were the foundation stone on which huge personal fortunes were created in the past. When I first read the reminiscences of a stock operator, there were 3 key questions that came to my mind, and I am sure that at this point you guys might be asking yourself those 3 questions too. Is volume still relevant today? Is it relevant to the forex market? And can it be applied to all trading and investment strategies? In order to understand the first question, I will explain the concept of volumes. Volumes reveal activity of market makers or professionals in foreign exchange markets who set exchange rates on any forex pair. Therefore, a volume validates the price and gives us the complete picture of supply and demand coupled with sentiment as the large operators move in and out of the markets. So, yes, volume is as relevant today as it was 100 years ago, as it has become the standard of technical analysis over the years. In order to understand the second question, I want you to remind yourself of what I have emphasized in part 1 of the course. Remember guys, I taught how there always will be market manipulation in the forex markets. In fact, in many ways, it might be the most widely manipulated market of all. Therefore, the only tool for price validation that we retail traders have at our disposal to fight back is volumes. Various studies over the years have shown that the free volume indicator available to retail traders represents almost 90% of the true market activity. This activity representing volume is pure and simple to analyze. While it isn't perfect, I can guarantee you one thing, that you will be more successful using it than not, and you will see why in the remaining course. So the answer to our second question is also yes, because the approach is universal. And finally, I can only answer the third question from a personal perspective. Guys, I started using volumes in my trading once I decided to trade the larger time frames. However, the volumes on 1 hour and 4 hour chart gave me less confidence compared to using volumes on daily and weekly charts for price validation. Let's understand the point I'm trying to make using volume indicator on 4 hour charts versus a daily chart on MetaTrader 4 platform. Before that, quickly go through the next slide to understand how to add volumes to your forex chart. Now guys, what you see here are volumes represented on a 4 hour chart and daily chart. If you carefully analyze volumes on 4 hour charts, you will notice patterns of spikes in volumes which repeat over and over again. This is due to an increase and decrease in number of trading participants over a complete trading day as different financial centers over the world open and close. On the other hand, volumes reported on daily charts represent the number of trading participants that were active during the complete day, hence presenting a considerably more honest picture on volumes. So to answer the third question, I would suggest that if you wish to trade on smaller time frames, please make sure that you pay special attention to spikes in volumes so as to avoid false trades. This is because the smaller time frames' ability to validate price based on volumes is not as strong as those of larger time frames. Guys, this also concludes the first lecture on introduction to volumes, and I will see you in the next lecture.